In this video, we will be discussing dealing ranges. Now, there are many ways to identify dealing ranges, and we will cover each method in future videos here on the YouTube channel. But for this video, we are going to discuss the most basic way to correctly identify a dealing range. First, let's discuss this simple way that we can identify a dealing range high and a dealing range low. A dealing range high is the swing high that sweeps buy-side liquidity, and the dealing range low is the swing low that sweeps sell-side liquidity. Let's take a look at a visual representation of this methodology. First, we need to have a clear draw on liquidity. Let's assume that we are bullish and that we are looking at the higher time frame, and this is our draw on liquidity. After establishing our bias, we need to look at this most recent price leg. Here, we can see that this swing low was formed after sweeping sell-side liquidity, while this swing high was formed after sweeping internal buy-side liquidity. This now constitutes this swing low as our dealing range low, and this swing high as our dealing range high. So, how do we use this information? Before reaching our higher time frame draw on liquidity, price will seek a discount of the dealing range that we have established. So what we need to do is locate an inefficiency in a discount of the dealing range like we see right here. Once price reaches this discount inefficiency, we should expect price to bounce and continue the higher time frame trend, delivering to our draw on liquidity. Let's go take a look at some examples in the charts. So if we are looking at this daily chart here on the S&P 500, let's talk about some of the concepts that we just discussed up until this point in the video. We can see here that we came down and swept sell side liquidity, and then we have a aggressive bounce back to buy side. And then after we come up here, we sweep highs here and we sweep another high here. So that means that this here is our dealing range low, and this is our dealing range high. But before we progress here, what is most important? We have a clear draw on liquidity up here, which is our all-time high, or in other words, our bias is bullish. So if we are looking for higher prices and we start to see the market come down for a retracement without purging our draw on liquidity, then it is time to locate our dealing range. So again, our dealing range low, as I grab my Fibonacci tool, is right here to the dealing range high, the last swing high that was made after sweeping buy-side liquidity before we started to retrace. And what do we see here? This low comes right down just a point past equilibrium, or 50% of this dealing range, to bounce before continuing higher, progressing towards the draw on liquidity. So if you look here in a discount, looking at this daily chart, there were no clear inefficiencies below here. But if we look to the left side here, we have an inversion fair value gap. So if I make this a little bit darker here, we'll be able to see that more clearly, how this inversion fair value gap was overlapping with equilibrium of the dealing range, where we can expect a bounce and for price to continue the higher time frame trend. Now, if we look at dollars daily chart here, let's talk about the same concepts and how we can implement them when looking at this price action. I want to focus first on this fractal of price here, okay? We came up and swept these highs, so just to make it clear to everyone, we're sweeping buy-side liquidity right here. And we're, of course, when this low is formed, we're sweeping a lot of sell-side liquidity, and then we start to see the market retrace. So when we are bearish, like we are seeing here in dollar, and you start to see dollar climb back up for higher prices, it doesn't just mean that the higher time frame sell-side delivery is going to stop and now we're going all the way back up to the highs. It is important for us to measure this dealing range and look at equilibrium of that range. And if I zoom in here, what do we see? We see that we come up to equilibrium, fail to fill the totality of this SIBI that is residing within an overlapping equilibrium and within a premium of this dealing range, and we continue lower to that higher time frame draw on liquidity. Now, if I erase some of these annotations, you might be asking, well, right here, how could we have known that this was a dealing range? And it is find to constitute this as a dealing range? And if we do, we can see that it came up to a premium before resuming lower. But with the dealing range high on the daily chart here, you can say, well, we didn't purge any swing highs here. So how can we constitute that as our dealing range high? This will be discussed in future videos here on this channel. As I mentioned, there are many ways to identify a dealing range, but the most basic, most fundamental way is to look at a swing high that swept buy-side liquidity for your dealing range high, and a swing low that swept sell-side liquidity for your dealing range low to find that high and low for a dealing range. I hope you guys enjoyed this video. If you guys have any questions, make sure to leave them in the comments, and be sure to join my free Discord. That link will be in the description of this video. I will talk with everybody soon. Good luck and good trading.